Hello, traders. Once again, I'm here to expose the true nature of online trading, so you can avoid making costly mistakes that crash so many trading accounts. Today, we're talking about what really drives market prices: sentiment. If you're not factoring emotional market sentiment into your forecasting, you're probably losing money. But it doesn't have to be that way, and all you need to do is listen for the next 7 minutes. It's the most powerful influence on the global economy. It doesn't show up on charts, and if you are hearing about it on the news, it's already too late to trade on it. It can make and break even the biggest companies, crush even the most cautious traders, and it often makes no sense whatsoever. It's called market sentiment, and it is the real power behind what drives all prices. From oil to tech stocks, major currencies to crypto, nothing is immune to its touch. And if it's bullish, the sky is the limit. To understand market sentiment is to see the global investment world like a billionaire or hedge fund manager sees it. At its core, market sentiment represents the collective emotional state of investors, which, much like human emotions, can lead to panic and even recession.
No!
It can move markets in minutes with both rallies and crashes. And once it starts, there's nothing anyone can do to stop it. It's a dance of greed, fear, and uncertainty, and understanding it is key to navigating the global market. Think of sentiment as a psychological pulse check of the market, influenced by a myriad of factors beyond financial metrics: news, rumors, social media, and even geopolitical events. To truly grasp the profound impact of market sentiment, let's delve into two compelling case studies: Volkswagen and Google. The year was 2015, when Volkswagen found itself engulfed in the Dieselgate scandal, a revelation that shook the automotive industry to its core. Volkswagen Group were outed for blatant manipulation of their so-called greener emissions engines. By reprogramming the computers that measured exhaust gases, they skirted climate change initiatives, which allowed them to emit more harmful pollutants than legally allowed. Caught red-handed. Suddenly, VW's stock took a nosedive, losing billions in market capitalization, and it seemed as if the company's very existence was at stake. Market sentiment may have swung to a negative extreme due to the scandal, but car sales continued to increase year over year. Some might say the lying and cheating increased Volkswagen's market share.
Well, that doesn't make sense.
The aftermath of the Dieselgate scandal offers a valuable lesson. Market sentiment can be a capricious beast, capable of exerting tremendous influence on stock prices, often without a direct correlation to a company's financial fundamentals. Fast forward to 2023, a year that witnessed Google's highly anticipated introduction of Bard, its AI chatbot. Bard's debut, however, included an unforeseen hiccup, a mistake that was immortalized in the international product demo. The outcome? Google's stock crashed with a loss of over $100 billion in less than 24 hours. But why did such a minor tech misstep affect Google's market value so profoundly? After all, ChatGPT and all the other chatbots make mistakes all the time. Everybody knows it. So was this enough to send investors into a bearish panic? The answer lies in the enigmatic realm of market psychology.
I'm not joking, I'm serious.
Market sentiment is a fusion of psychology, perception, and news, and it wields significant power over the financial world. It can flip the script on stock prices, often disregarding a company's financial health. This intricate interplay between perception and reality can create a volatile cocktail. To put it simply, understanding market sentiment is like deciphering a multifaceted puzzle, complex yet profoundly insightful. Just remember that market sentiment isn't always rational or predictable. Try standing in a busy square with a friend and pointing at the sky. It won't be long before everyone is looking up. And we all know what would happen next if somebody screams that explosive 4-letter word in a cinema. We are hardwired to react first and think later. It's what's kept humans alive this long. Emotion and sentiment are unpredictable forces, and deciphering the nuances is an art form that keeps traders on their toes. In essence, market sentiment is like the ever-changing weather. It might not always make sense, but understanding its patterns can be a valuable skill. Successful traders learn to navigate not just financial data, but also the emotional landscape of the market. When investors smell trouble, then run first, then look back, which means you have to do the same, immediately. By recognizing the emotional undercurrents, you can make more informed decisions and stay ahead of the curve. Keep in mind that market sentiment is a complex amalgamation of various factors, including investor sentiment, consumer sentiment, and even political sentiment. Traders often turn to sentiment indicators and sentiment analysis tools to gauge the prevailing mood in the market. These tools track news sentiment, social media sentiment, and sentiment related to specific sectors or industries. Sentiment indicators can provide valuable insights into market trends, helping traders anticipate potential shifts in stock prices. Just remember that sentiment tools chase market sentiment. They are always behind playing catch-up. Market sentiment can exhibit herd behavior, where investors follow the crowd, leading to exaggerated price movements. Positive sentiment can drive stock prices to dizzying heights, even if the underlying fundamentals don't justify the valuation.
We all know how that turned out.
Conversely, during a bear market, fear and negative sentiment can trigger a downward spiral, creating opportunities for savvy investors. Pause the video and ask yourself which assets are currently high when they shouldn't be. For example, despite massive debt and a crumbling economy, USD is still holding strong. But for how long? What could trigger a panic, and how quickly would investors jump ship? And what else is overpriced right now? To further complicate matters, market sentiment can vary across different asset classes and timeframes. Sentiment in the stock market may differ from sentiment in the bond market or the cryptocurrency market. It can also change rapidly, responding to breaking news, earnings reports, or geopolitical events. Market sentiment can be influenced by the actions of prominent investors, such as Warren Buffett or Elon Musk, whose statements can move markets. Media coverage plays a significant role in shaping sentiment, as headlines can create fear or optimism among investors. For instance, news of a major company's earnings miss can trigger a negative sentiment wave, causing investors to panic sell. Additionally, social media platforms like Twitter and Reddit have emerged as influential sources of sentiment in recent years. Social media sentiment analysis has become a valuable tool for traders seeking to gauge public opinion and sentiment trends. Market sentiment is a multifaceted concept that blends psychology, perception, and news to influence stock prices. While it may not always align with a company's financial health, it remains a force to be reckoned with in the world of finance. As traders, understanding market sentiment and its nuances can be the key to successful decision-making and navigating the ever-changing landscape of the stock market. So, traders, as you continue your journey in the financial markets, remember that the mood of the market can be as important as the metrics on your balance sheet. Stay vigilant, stay informed, and stay ahead of the curve. Thank you for joining us on this exploration of market sentiment. Stay tuned for more in-depth insights into the captivating world of finance. Before I go, I'd like to explain myself a little. As much as I would like to be on camera, I will need to remain anonymous. I work for a large European liquidity provider, and big banks don't like it when somebody tells traders what the real deal is. I didn't monetize this channel, and I'm not promoting my company as an affiliate. I'm just telling you the truth about the trading. If you'd like me to continue producing these revelations, then go check out my other videos, like and subscribe. Otherwise, this channel will disappear into oblivion and the knowledge I want to share will be lost. If you know other traders, share the link and discuss my conclusions. Explore the perspectives and do your own research. You and your friends will be better traders for it. It absolutely is possible to profit from trading. I've seen the statistics, I've seen the big winners, and over the coming months I'm going to share how they are doing it and the things they are not doing. So until the next video, be smart, trade cautiously, and don't believe everything you see on the news.